What's happening right now in the precious metals market is something most people are completely missing. While everyone's distracted by the daily noise, there's a window opening that hasn't been this wide in over a decade. And here's what makes this moment so critical. The people who understand what's unfolding are moving fast, while everyone else is sitting on the sidelines wondering if they should wait for a better entry point. Let me show you exactly what I'm talking about. Gold has been consolidating in a pattern that technical analysts call a bull flag. And if you understand what that means, you know that these formations typically resolve with explosive moves higher. But this isn't just about chart patterns. What's happening beneath the surface is far more significant than any technical setup. Central banks around the world have been accumulating physical gold at a pace we haven't seen since the early 1970s. Think about that for a moment. These are the institutions that print money, that control interest rates, that have access to every economic data point imaginable, and they're converting their reserves into gold at record levels. The World Gold Council's latest data shows central bank purchases running at multi-decade highs, with emerging market central banks leading the charge. China, Russia, India, Turkey, Poland. The list goes on. These aren't random purchases. This is strategic positioning. Now here's where it gets interesting. While central banks are buying physical metal, the paper markets are showing something completely different. The COMEX futures market, where most price discovery happens, has a ratio of paper claims to physical metal that's reaching levels that should make anyone nervous. We're talking about potentially hundreds of paper ounces for every physical ounce that could actually be delivered. This creates a situation where the price you see quoted doesn't reflect the true supply and demand dynamics of the physical market. And silver? Silver's story is even more compelling because it sits at this unique intersection of being both a monetary metal and an industrial commodity. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. The green energy transition that governments worldwide are pushing isn't optional anymore. It's mandated policy. And silver is absolutely essential to making it happen. But here's what most people don't realize. Silver mine production has been essentially flat for years. We're not discovering major new deposits. The easy silver has already been mined. Meanwhile, industrial demand keeps climbing. The solar industry alone is projected to consume massive amounts of silver over the next decade. Add in the electrical vehicle revolution, 5G infrastructure, and all the other technological applications, and you've got a supply-demand equation that simply doesn't balance. Before we go further, I want to mention something quickly. I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, no obligation, just information that could be valuable as you think about your own financial security. All right, back to what's happening in these markets. Let's talk about what happened the last time we saw a setup like this. Go back to the period between 2008 and 2011. Gold went from around $800 an ounce to over $1,900. Silver went from $9 to nearly $50. Those weren't gradual moves. Once they started, they accelerated fast. And the people who waited for a pullback to get in, many of them never got their chance. The market just kept running higher. What caused those moves? It was a combination of factors remarkably similar to what we're seeing now. You had central banks printing money on an unprecedented scale. You had concerns about the stability of the financial system. You had geopolitical tensions rising. You had investors losing faith in traditional safe havens. Sound familiar? But here's what's different this time, and why this opportunity might be even more significant. Back then, we didn't have the level of government debt we have now. The United States is carrying debt levels that would have been unthinkable 15 years ago. And it's not just the US. Japan, Europe, China. Everyone's leveraged to levels that create systemic fragility. When you have this much debt in the system, there are only two ways out: default or inflate. And governments always choose inflation because it's politically easier. Think about what inflation really means. It's a hidden tax on savings. Every dollar you have in the bank loses purchasing power. Your retirement account might show the same number of dollars, but what those dollars can buy keeps shrinking. This is why people who understand monetary history get so focused on hard assets. Gold and silver can't be printed. Their supply is limited by geology and mining economics. When currencies lose value, Precious metals tend to preserve purchasing power. Now let's look at what's happening in the physical market right now. Premiums on physical silver coins and bars have been elevated for months. What does that tell you? It means demand for physical metal is outstripping supply at current prices. Dealers are having to pay more to secure inventory. Mints are struggling to keep up with orders. This is the real market speaking, and it's saying something very different from what the paper price suggests. The gold market is showing similar dynamics, just less extreme because gold's market is larger and more liquid. But even there, you're seeing tightness. Delivery times are extending. Premiums are rising. The spread between paper and physical is widening. These are all signs of a market under stress. And here's something that doesn't get talked about enough. The mining industry is in trouble. It takes years to bring a new mine into production. Exploration budgets were slashed during the last bear market. Environmental regulations have made permitting more difficult and time-consuming. Energy costs for mining operations have soared. All of this means that even if prices rise significantly, supply can't respond quickly. That's the setup for a sustained bull market, not just a quick spike. Let me tell you about something that happened recently that really illustrates what we're dealing with. There was a situation where a major bank had to scramble to source physical gold to meet delivery obligations. This isn't supposed to happen in a well-functioning market, but it did, and it's not an isolated incident. There have been multiple reports of tightness in the physical market that don't make headlines, but are absolutely significant for anyone paying attention. The COMEX itself has had to adjust its rules multiple times in recent years to deal with delivery issues. They've changed margin requirements, altered delivery procedures, modified contract specifications. Why would they need to do this if everything was functioning smoothly? The answer is that the paper market has grown so large relative to the physical market that it's becoming unstable. Now think about what happens if we get a real crisis. Not a theoretical crisis, but something that makes people question the safety of the financial system. What happened in 2008? People rushed to safety. Gold spiked. But that was before we had the level of money printing we've seen since then. That was before government debt reached these levels. That was before we had this much geopolitical tension. The next crisis, whenever it comes, is likely to be met with even more aggressive monetary and fiscal stimulus, because that's the only tool policymakers have left. They can't raise interest rates significantly without crashing the economy under the weight of debt service. They can't cut spending without political backlash, so they'll print, and when they print, hard assets benefit. Here's where the retirement angle becomes critical. If you're sitting on a traditional retirement account, you're probably heavily weighted towards stocks and bonds. That's what most financial advisors recommend. But think about what that really means. Stocks are claims on companies that operate in an economy that's increasingly fragile. Bonds are promises to pay you back in currency that's being systematically devalued. Is that really where you want your life savings concentrated? This is why more and more people are looking at alternatives. And one of those alternatives that's gained significant traction is holding physical precious metals inside a retirement account structure. Now, I'm not going to tell you what to do with your money. That's between you and your financial advisor. But I will tell you that if you have $100,000 or more in retirement accounts, it's worth understanding how this works. I put together a comprehensive guide on gold IRAs that explains the mechanics, the tax implications, the pros and cons. It's in the description. There's no cost, no obligation. It just walks through how you can get physical gold into a retirement account without triggering tax penalties. Whether that makes sense for your situation is something you'll need to evaluate. But at least you'll have the information to make an informed decision. Because here's the thing. If we're right about where this market is headed, the time to position yourself is before the move happens, not after. All right, let's get back to the market dynamics. One of the most fascinating aspects of what's happening right now is the divergence between East and West. Western investors, particularly in the United States and Europe, have been relatively slow to embrace precious metals this cycle. ETF holdings have been mixed. Retail investment has been modest. There's still a lot of skepticism, a lot of people who got burned in previous cycles and are hesitant to jump back in. But in Asia, completely different story. Physical demand in China and India has been enormous. These are cultures with a long history of valuing gold and silver. They understand monetary metals in a way that Western investors often don't. And they're accumulating. Chinese consumers are buying gold bars and jewelry at record levels. Indian wedding season drives massive physical demand. These aren't speculators. These are people converting their savings into hard assets because they don't trust their currency or their banking system. This creates an interesting dynamic. If Western investors start to shift even a small percentage of their portfolios into precious metals, the impact on prices could be dramatic. We're talking about trillions of dollars in pension funds, retirement accounts, and investment portfolios. If even 5% of that money decided to allocate to gold and silver, where would the metal come from? The market simply isn't large enough to absorb that kind of demand without significant price appreciation. And here's another factor that's often overlooked: the generational wealth transfer that's happening right now. Baby boomers are retiring and passing wealth to younger generations. Millennials and Gen Z have very different views on investing than their parents. They're more skeptical of traditional institutions. They're more open to alternative assets. They grew up during the financial crisis and saw how the system works. Many of them are naturally drawn to assets that exist outside the traditional financial system. This generational shift could be a major driver of precious metals demand over the next decade. We're already seeing it in the cryptocurrency space, where younger investors have embraced digital assets despite skepticism from older generations. Precious metals offer something similar: an asset that's not dependent on the traditional financial system, but with thousands of years of history proving their value. Let's talk about the geopolitical dimension for a moment, because this is huge and most people aren't connecting the dots. The world is fragmenting. The post-World War II order that's been in place for decades is breaking down. You've got rising tensions between major powers, you've got trade wars, you've got sanctions and counter-sanctions, you've got countries actively working to reduce their dependence on the dollar-based financial system. This de-dollarization trend is real and it's accelerating. Countries are settling trade in their own currencies. They're building alternative payment systems. They're diversifying their reserves away from dollars and into gold. This isn't conspiracy theory stuff. This is official policy in multiple countries, and it has profound implications for the dollar's role as the global reserve currency. If the dollar loses its reserve status, even partially, what happens to all those dollars that are currently held overseas? They come home, and when they come home, they create inflation. This is basic monetary economics. More dollars chasing the same amount of goods and services means higher prices, and in that environment, hard assets like gold and silver become increasingly attractive. Now, I'm not saying the dollar is going to collapse tomorrow. That's not the point. The point is that the trend is clear, and trends in geopolitics and monetary systems play out over years and decades, not days and weeks. The people who position themselves early in these trends are the ones who benefit most. Let me give you a historical parallel that might help frame this. In the 1970s, we had a similar setup. The Bretton Woods system collapsed. The dollar was devalued. Inflation surged. And gold went from $35 an ounce to over $800. That's more than a 20-fold increase. Silver did even better on a percentage basis. Now, I'm not predicting we'll see moves of that magnitude. The market is different now. More liquid, more sophisticated. But the fundamental drivers are similar: monetary instability, geopolitical tension, loss of confidence in fiat currency. And if history is any guide, precious metals tend to perform very well in these environments. Here's something else to consider: the opportunity cost of not being positioned. Let's say you're skeptical about precious metals. You think this is all hype. Fine. But what if you're wrong? What if we do see a major move higher? What if gold goes to 6,000 or 7,000 an ounce? What if silver goes to 100 or 150? If you're not positioned at all, you miss the entire move. And these moves, when they happen, tend to be fast. You don't get a lot of time to think about it. On the other hand, if you allocate a reasonable portion of your portfolio to precious metals and the big move doesn't materialize, what have you lost? Precious metals have historically held their value over long periods. They're not going to zero. They're not going to disappear. At worst, you've got a portion of your portfolio in an asset that preserves purchasing power. That's not a bad outcome. This is why so many sophisticated investors maintain a core position in precious metals, regardless of short-term price movements. It's insurance. It's diversification. It's a hedge against the kind of monetary and geopolitical chaos that seems increasingly likely in the world we're living in. Let's talk about silver specifically for a moment, because silver's story is unique and incredibly compelling. Silver has this dual nature. It's a monetary metal with thousands of years of history as money, but it's also an industrial commodity that's essential for modern technology. This creates a situation where silver benefits from both investment demand and industrial demand. The industrial demand side is particularly interesting right now. The push toward green energy is creating unprecedented demand for silver. Solar panels are the biggest driver. Each panel requires a certain amount of silver for the photovoltaic cells. As solar installations increase globally, silver demand from this sector alone is projected to grow exponentially. And this isn't speculative demand. This is actual physical consumption. Once silver goes into a solar panel, it's gone. It's not coming back to the market. Electric vehicles are another major source of demand. EVs use significantly more silver than traditional internal combustion vehicles because of all the electrical components and wiring. As the automotive industry transitions to electric, silver demand from this sector is set to surge. Again, this is physical consumption, not investment demand that can reverse. Then you've got 5G infrastructure, which requires silver for all the connections and components. You've got medical applications. You've got electronics. The list goes on. All of this adds up to industrial demand that's growing faster than supply. And remember, mine supply is essentially flat. We're not finding major new deposits. The silver that's easy to mine has already been mined. This creates a supply-demand imbalance that's only going to get worse. And unlike gold, where most of the gold ever mined still exists in some form, silver gets consumed. It's used up in industrial applications. This means the above-ground supply of silver is actually shrinking even as demand is growing. That's the setup for a serious supply squeeze. Now, there's been a lot of talk in the silver community about the possibility of a short squeeze in the paper market. The theory is that there are large short positions held by commercial banks that could be forced to cover if physical demand overwhelms the available supply. Whether that happens or not, I can't say. But what I can say is that the fundamentals support much higher silver prices regardless of what happens with the paper market. The gold-to-silver ratio is another interesting data point. Historically, this ratio has averaged somewhere in the range of 15 to 1 to 60 to 1. Right now, we're toward the higher end of that range. What does that mean? It means silver is cheap relative to gold. And historically, when the ratio gets this stretched, it tends to revert to the mean. That reversion usually happens with silver outperforming gold on a percentage basis. So, if you believe gold is going higher and you look at the gold-to-silver ratio, the logical conclusion is that silver should go even higher on a percentage basis. This is why many precious metals investors overweight silver relative to gold. They're playing for that ratio compression. Let me bring this back to the practical level for a moment. If you're watching this video, you're probably thinking about your own financial situation. You're probably wondering if this is something you should act on. And that's a decision only you can make. But let me give you a framework for thinking about it. First, understand that precious metals are not a get-rich-quick scheme. They're a long-term store of value and a hedge against monetary instability. If you're looking to double your money in 6 months, this probably isn't the right vehicle. But if you're looking to preserve purchasing power over years and decades, and potentially benefit from a major bull market in hard assets, then precious metals deserve serious consideration. Second, think about your overall portfolio allocation. Most financial advisors suggest that precious metals should be somewhere between 5 and 20% of a diversified portfolio. The exact percentage depends on your risk tolerance, your time horizon, and your overall financial situation. But the point is that you don't need to bet the farm on precious metals to benefit from them. Even a modest allocation can provide meaningful diversification and downside protection. Third, understand the difference between paper and physical. ETFs and mining stocks can be convenient and liquid, but they're not the same as owning physical metal. If you're buying precious metals as insurance against systemic risk, you want to own the physical metal, not a claim on metal that might or might not be there when you need it. This is why so many serious precious metals investors focus on physical ownership. either directly or through allocated storage programs. Now, for those of you who've stuck with me this far, I want to mention something important. If you're an American retiree with at least $100,000 in any retirement account, and you've watched this entire video, you qualify for something special. In the description, there's information about how to schedule a free one-on-one educational web conference. This is completely no obligation. It's just an opportunity to have a conversation with someone who can walk you through your specific situation and help you understand your options. This is only available to people who mention they watched this video all the way through, so make sure you mention that when you reach out. Let's wrap this up by talking about timing, because that's what everyone wants to know. Is now the right time to get positioned? Should you wait for a pullback? What if prices go lower before they go higher? Here's the truth. Nobody can time the market perfectly. Nobody. The people who try to catch the exact bottom usually end up missing the move entirely. What successful investors do is identify long-term trends and position themselves accordingly. They don't worry about getting the perfect entry price. They worry about being positioned before the major move happens. And right now, all the indicators suggest we're in the early stages of a major bull market in precious metals. You've got central banks buying. You've got supply constraints. You've got monetary instability. You've got geopolitical tension. You've got industrial demand growing faster than supply. These are the ingredients for a sustained move higher. Could prices pull back in the short term? Sure. Markets don't move in straight lines. There will be corrections and consolidations along the way. But if you're focused on the long-term trend, those short-term moves are just noise. The people who bought gold at $800 in 2008 and watched it pull back to $700 probably felt pretty smart. Until gold went to $1,900 and they realized they'd been focused on the wrong thing. The opportunity that exists right now is about positioning yourself for what's coming, not trying to trade every wiggle in the price. It's about understanding that the monetary system we've lived under for the past 50 years is under stress, and that stress is likely to intensify. It's about recognizing that hard assets have historically performed well in these environments, and that the setup right now is as compelling as it's been in a long time. So what should you do? Start by educating yourself. Understand what you're buying and why. Look at the fundamentals. Look at the history. Look at what's happening in the world around you. Then make a decision based on your own situation and your own risk tolerance. Don't let fear or greed drive your decisions. Don't chase prices higher or panic sell on pullbacks. Have a plan and stick to it. And remember, the people who benefit most from major market moves are the ones who position themselves early and hold through the volatility. They're not the ones trying to trade in and out. They're not the ones waiting for the perfect entry. They're the ones who recognize an opportunity, take action, and have the patience to let it play out. The window we're talking about isn't going to stay open forever. As more people recognize what's happening, as prices start to move, as the mainstream media starts covering it, the opportunity changes. The best risk reward is always early in the trend, before everyone else figures it out. That's where we are right now. The question is whether you're going to take advantage of it or watch from the sidelines and wish you had.